Welcome back to Finscribble. If you turn on the news, you might think Wall Street's giant hedge funds are run by rogue, sentient algorithms frantically pressing the buy and sell buttons at light speed. But that is complete fiction. The real secret to how top funds dominate the market today isn't autonomous trading robots. It's sheer data processing speed and scale. Decades ago, a single human financial analyst like Maya had to spend 40 exhausting hours manually digging through a single corporate annual report, highlighting line items with a yellow pen. Today, modern hedge funds deploy armies of customized AI agents that can ingest, cross-reference, and summarize over 500 corporate SEC filings before Maya even finishes her morning coffee. AI hasn't replaced the human trader on Wall Street. Instead, it has transformed into the ultimate research exoskeleton, giving smart investors superpowers to spot hidden market signals in seconds.
To understand this dynamic, picture a Formula One race car flying around the track at 200 miles per hour. Portfolio manager Maya is sitting squarely in the driver's seat, making split-second decisions on where to steer her portfolio. She isn't staring at thousands of raw data points while taking sharp turns. Instead, an elite digital pit crew of AI algorithms works behind the scenes, in real time. Imagine trying to listen to 10,000 radio stations simultaneously while keeping your eyes on the road. That is what managing a multi-billion-dollar fund used to feel like without automation. The AI pit crew acts as an intelligent filter, crunching massive noise into crystal-clear telemetry. It tells Maya exactly when tire friction is dropping or when a competitor is about to make a pit stop. AI handles the heavy mechanics, but Maya keeps her hands firmly on the wheel to make the ultimate trade.
So, what kind of crazy data is this AI pit crew actually analyzing? Beyond traditional financial balance sheets, hedge funds spend millions on unstructured alternative data. Computer vision algorithms scan high-resolution satellite photos of retail parking lots across America every single morning. By counting cars outside major retail chains, the system predicts foot traffic trends weeks before quarterly earnings reports are officially released. Meanwhile, specialized natural language processing models crunch millions of anonymized credit card transaction streams and international shipping vessel logs in real time. If giant cargo ships packed with microchips are delayed at ocean ports, AI detects the underlying supply chain bottleneck instantly. Maya receives an automated highlight alert on her dashboard, showing revenue forecasts shifting long before retail analysts even wake up. Translating raw, unstructured data into predictive, actionable alpha is precisely what gives modern institutional funds their massive competitive edge in today's fast market.
Beyond external data, AI agents revolutionize how funds read official company filings. Corporate reports are intentionally buried in hundreds of pages of tedious legalese and dense financial footnotes. A customized large language model doesn't just read the main text, it instantly compares a company's new quarterly filing against every report filed over the past 10 years. If an executive quietly changes a subtle phrase in the risk factor section, like switching expected growth to potential headwinds, the AI flags it in red instantly. Furthermore, speech-to-text algorithms analyze audio recordings of corporate earnings calls. They evaluate acoustic pitch, vocal hesitation, and speech pacing, detecting when executives sound uncertain while answering tough analyst questions. Maya doesn't have to read 300 pages of legal jargon to find the hidden trapdoors. Within seconds, her screen highlights the exact 3 sentences where executive confidence dropped and financial risk increased significantly across the quarter.
Now, you might wonder, if these AI tools are so smart, why not just remove Maya completely and let the computer trade autonomously? The answer comes down to one terrifying word: hallucinations. Generative AI models are notorious for confidently inventing facts, misinterpreting context, or misreading sarcasm in news headlines. In financial markets, a single hallucinated figure or miscalculated margin metric can cost a fund tens of millions of dollars in seconds. That is why multi-billion-dollar hedge funds strictly enforce a strict human-in-the-loop framework today. The AI acts as an eager, lightning-fast junior analyst that generates hypotheses, gathers evidence, and flags anomalies. But before any trade order hits the exchange, Maya verifies the underlying data source, cross-checks the logic, and weighs overall risk. AI provides the high-powered analytical intelligence, but human oversight, emotional discipline, and strategic risk management will always sign the final trade check at the end of the day.
So, what does Wall Street's rapid AI evolution mean for everyday retail investors like you and me? You don't need a multi-million-dollar hedge fund budget to build your own intelligent research workflow. By utilizing modern LLM tools, custom GPT agents, and automated data summarization features, individual investors can analyze earnings transcripts and SEC filings in minutes instead of spending entire weekends buried in PDF files. Just remember the fundamental rule that Wall Street lives by. Treat AI as a research co-pilot, never an autopilot. Let technology handle the heavy lifting, the document scanning, and the initial data synthesis, but always bring your own critical thinking and risk control to the final investment decision. When you combine artificial intelligence with human wisdom, you build a sustainable investing edge that stands the test of time. Make sure to like, subscribe, and hit that notification bell for more Finscribble deep dives. As always, appreciate you hanging out today. See you in the next one.